If you invested $1,000 into Bitcoin during the 2012 halving, you would have millions today. If you did the exact same thing in 2016, you would have hundreds of thousands of dollars. By 2020, that same $1,000 would have only given you a few tens of thousands. Do you see the pattern yet? According to basic linear mathematics, do you really think the recent halving and the current market in 2026 will suddenly make you insanely rich overnight? You are wrong. You are walking directly into the most sophisticated wealth extraction machine in modern financial history. Welcome to Financial Traps. Today we are going to dissect the doomsday clock of crypto and exactly why investing your hard-earned money into Bitcoin right now might just be the most expensive mistake of your entire life. Let us rewind the clock to understand the absolute perfection of the trap you are currently standing in. The year was 2009. The global financial system was bleeding out from the 2008 subprime mortgage crisis. People were losing their homes, their savings, and their futures, while reckless bankers were getting massive bailouts printed out of thin air by the government. The system was completely rigged. The trust in traditional fiat currency was fractured. In the shadows of this economic collapse, a mysterious figure named Satoshi Nakamoto released a brilliant piece of code. It was meant to be a digital rebellion, a decentralized financial network that could never be inflated by any central bank, manipulated by greedy politicians, or controlled by corporate monopolies. The core genius of this new system relied on two unbreakable mathematical rules. First, there will only ever be 21 million Bitcoins in existence. Never a single drop more. It is absolute digital scarcity. Second, and most importantly, is a hard-coded mechanism known as the halving. Every 4 years, or exactly every 210,000 blocks, mined the amount of new Bitcoin created and given to miners to secure the network is slashed exactly in half. This is the heartbeat of the network. But how does this mechanism actually work in practice? And why did it make so many early adopters incredibly wealthy while leaving others holding the bag? Let us break this down so a 5-year-old can understand. Imagine a small, isolated village that has a magical gold machine sitting right in the middle of the town square. Every single day, this machine spits out exactly 50 gold bars. The villagers get entirely used to this rhythm. The local economy adapts. They trade their chickens, their cows, and their labor based on the predictable fact that 50 new gold bars will enter their economy daily. Now imagine the machine was programmed by its creator with a secret internal gear. Suddenly, after exactly 4 years of flawless operation, the gears shift and crunch. The machine now only spits out 25 gold bars a day. The villagers still want the gold just as badly. Their demand for the shiny metal has not changed at all. But the daily new supply was just brutally cut in half overnight. What happens next? Absolute panic buying. The price of the gold bars explodes because everyone realizes the new supply is drying up, and getting your hands on one is suddenly twice as hard. This is exactly what the Bitcoin halving is. It is a predictable, engineered supply shock. And this was the ultimate mathematical loophole that early tech nerds and Wall Street outsiders discovered and mercilessly exploited. They realized a very simple truth. If you know the exact date and time when the magical gold machine is going to cut its production in half, All you have to do is buy up as much supply as you possibly can right before the gears shift. You accumulate quietly. Then you just sit back, relax, and watch the inevitable panic buying from the rest of the world drive your net worth to the moon. In 2012, the block reward dropped from 50 to 25. The price skyrocketed from mere dollars to over 1,000. The loophole worked perfectly. In 2016, the reward dropped again to 12.5. The price went absolutely ballistic, approaching $20,000. In 2020, it dropped to 6.25. Once again, the price pumped to new astronomical highs of $69,000. It became a self-fulfilling prophecy, a predictable mathematical loophole that slowly mutated into a global religion. Millions of retail investors started to blindly believe that the 4-year halving cycle was a guaranteed one-way ticket to generational wealth. They thought it was a law of physics. The trap was perfectly set. The bait was the undeniable historical data of the past decade, and basic human greed did the rest of the heavy lifting. But here is the terrifying reality that nobody on the internet pushing referral links is telling you right now. As these 4-year cycles repeated, something fundamentally and irreversibly shifted in the shadows of the market. The magical machine was no longer a secret kept by cypherpunks and basement miners. The biggest, the most ruthless, and the most heavily capitalized predators in the global financial system smelled the blood in the water. They saw a highly predictable pattern of retail investors throwing their life savings at a digital coin every 4 years like clockwork. And they decided it was time to hijack the entire casino. The loophole of predictable scarcity was about to be weaponized against the very people it was originally designed to protect. You see, to keep the price doubling and tripling, you need an exponentially larger amount of new money entering the system. But where does the money actually come from to push a trillion-dollar asset even higher? And why is the beautiful math that made the early adopters rich starting to brutally fail the modern investor? The answer lies in the massive institutional takeover and the silent slaughter happening right under your nose. The escalation of this cycle is completely unprecedented. By the time we reached the 2024 and 2025 era, the narrative had violently shifted. Bitcoin was no longer a fringe internet experiment. It became a fully regulated institutional asset. Wall Street finally capitulated. After years of calling it a fraud and a toxic scam, the largest financial institutions on the planet suddenly changed their tune. Spot exchange-traded funds were approved by the government and unleashed into the wild. Massive asset managers started scooping up hundreds of thousands of coins on behalf of their wealthy clients. Billions of dollars flooded the market in a matter of weeks. The multiplier effect was staggering. The magical clock was completely hijacked by men in expensive suits. They bought the supply aggressively in the dark corners of the bear market before the retail crowd even realized what was happening. They knew exactly how the psychology of the 4-year cycle worked. They understood that the halving was coming, and they front-ran the entire world. They built massive positions when the price was low and the sentiment was entirely broken. Now they control the board. The decentralized dream of Satoshi Nakamoto has essentially been absorbed by the very Wall Street monopolies it was designed to destroy. This is the ultimate irony of the modern financial system. But wait, Where does the money come from to keep pushing the price higher and higher? This is the core of the illusion. Here is exactly where things get mathematically terrifying for you right now in 2026. We must confront the unbreakable law of diminishing returns. In the early days, moving the total market capitalization of Bitcoin from $10 billion to $20 billion was relatively easy. It just required a small wave of enthusiastic internet nerds and a few $1 million in fresh capital. The order books were thin. The resistance was low. But moving an asset from a $1 trillion valuation to a $2 trillion or a $3 trillion valuation requires a microscopic level of global liquidity. It requires the gross domestic product of entire nations to flow directly into the system. The math simply stops adding up for those expecting massive, life-changing wealth. The percentage growth naturally and brutally compresses as the asset becomes heavier and more established. The illusion of the halving is that it guarantees explosive exponential wealth forever, regardless of the market cap. It absolutely does not. The current trap you are facing is entirely psychological. The mainstream media is currently pumping out endless articles about the next massive supercycle. Your friends and family are showing you screenshots of their portfolio gains from years ago. The fear of missing out is engineered to absolute perfection. It triggers the deepest parts of your brain that crave financial freedom and escape from the daily grind. But you have to ask yourself a very painful question. Who exactly are you buying from at these elevated prices today? Wall Street accumulated their massive positions in the depths of the bear market when blood was in the streets and nobody wanted to touch crypto. Now that the halving has passed and the narrative is reaching peak euphoria, they desperately need exit liquidity. They need regular, everyday retail investors to buy their heavy bags at a massive premium. When you smash that green buy button on your shiny exchange app today, hoping for a magical overnight doubling of your wealth, you are likely just handing your hard-earned cash directly to a ruthless hedge fund algorithm. An algorithm that is slowly and methodically locking in its profits at your expense. You are playing against the house, and the house has already won the early game. They are just waiting for you to place your chips on the table. To make matters worse, the entire system is now heavily propped up by dangerous amounts of hidden leverage. Retail investors, realizing that spot Bitcoin moves too slowly for them to get rich quick, are turning to the derivatives market. They are borrowing money they do not have to place highly leveraged bets on the future price. They use 10 times or even 50 times leverage to artificially multiply their potential gains. But this creates a massive, fragile house of cards. When the market experiences even a slight, sudden drop, these leveraged positions are violently liquidated by the exchanges. This triggers a cascading domino effect of forced selling, plunging the price even further into the abyss and wiping out billions of dollars in retail wealth in a matter of minutes. The whales know this. They actively hunt these liquidations. They push the price just enough to trigger the traps and sweep up the cheap coins left in the wake of the destruction. The governments of the world are currently trapped in an endless spiral of debt. They must print more currency to service the interest on their previous loans. This aggressively debases the value of the dollars, euros, or yen sitting in your bank account. Inflation is not a bug in the fiat system. It is a carefully designed feature meant to stealthily transfer wealth from the working class to the government. Bitcoin was originally designed as an escape hatch from this exact nightmare. But as the traditional financial world wraps its tentacles around the Bitcoin ecosystem, the line between the escape hatch and the trap becomes incredibly blurry. So, mathematically and logically speaking, is it a good idea to invest in Bitcoin right now? The answer is incredibly nuanced and depends entirely on your time frame, your risk tolerance, and your expectations. If you are buying Bitcoin because you truly understand the macroeconomic reality that traditional fiat currency is constantly losing its purchasing power, and you want a decentralized digital store of value for the next 10 or 20 years, then yes, it remains a pristine asset. It is a mathematical lifeboat against the reckless, endless money printing of central banks. It is digital gold in a world of decaying paper. But if you are buying it today because you think the halving magic trick is going to turn your small paycheck into a multi-million-dollar mansion by next month, you are walking directly into a financial slaughterhouse. You are not investing in the future of money. You are gambling blindly in a rigged casino where Wall Street controls the chips, the dealers, and the exit doors. History has proven time and time again that those who buy at the peak of the hype cycle, driven by pure blind greed, always end up subsidizing the massive profits of the patient and the wealthy. Do not let the illusion of the 4-year cycle blind you to the harsh reality of global liquidity and mathematical diminishing returns. The game has fundamentally changed forever. The easy money has already been made by those who took the risk when it was unpopular. Now it is a game of institutional trench warfare. Protect your capital, guard your emotions, and understand the true ruthless mechanics of the machine before you feed it your life savings.